Hi and welcome back. Um, hopefully you've all successfully completed the cash budgeting problem you had. I hope it wasn't too difficult, and I will get that corrected and back to you as soon as I can. I'm going to go on to Chapter 11, capital budgeting, and we've talked about operational budgeting. We've talked about cash budgeting. Both of those have to do with current operations and current expenses. Capital budgeting has to do with the investment in long-term assets. So we're running some kind of a business and we decide we need new capital equipment, new long-term equipment. This could be a marine transportation business where we're buying new ships. It could be a factory where we're buying new machines. It could be a trucking firm where we're buying new delivery vehicles, trucks, in other words. So it could be any number of things, but what all of these purchases or investments have in common is that these assets last for a long time, relatively speaking. So they may last 1 year, 3 years, 5 years, and they have returns over time. So in the first year, we're unlikely to recover 100% of our investment, but over time we will hopefully recover our investment and earn a return. So capital budgeting is looking at these potential investments and deciding whether they are worthwhile from a long-term investment perspective. So that's what we're going to be talking about. So as I said, analyzing investments in long-term projects. And there are three different common ways that people look at these things. The first one is called the payback method, and you've probably heard this, seen this, talked about this in general life. Well, if I put up solar panels on my house, I'm going to get a payback in 5 years, or 7 years, or 10 years, or 20 years, whatever. I'm going to get my money back in a certain amount of time. And that's called the payback method. We can all calculate that. We all understand that. I'm going to invest money and then I'm going to get it back at some point in time. The second method we'll talk about is called the net present value method. And the third method is called the internal rate of return method. These are probably the three most common methods. There are some others as well, but these are the ones we're going to talk about. And we'll talk about how they're used and who uses them and what the benefits and drawbacks to each one is. So the first thing you have to do is identify what the opportunities are. And generally speaking, there are more opportunities than there is available funds or available capital. So in most situations, there's lots of things we could invest in, and we have to decide which things to invest in because there are limited resources. And this is true of almost all investment decisions, no matter the size of the company or the success of the company. Even entities as large as the US government do not have unlimited funds and may have to make decisions about whether we should fund this or we should fund that. So it doesn't really matter. A lot of people say, well, he's rich, he can do whatever he wants, but not so true. There's always choices as to what to do with your investments. So two basic kinds of investments, long-term investments, they're investments in new things, new projects, or replacement and reinvestment in existing projects. So if you think about something we might all be familiar with, let's say a retail store, a new project would be we have one store, let's add another store in another place. That would be a new project investment. The second part, the reinvestment, would be let's remodel our existing store. Let's put in new carpets and better lights and new display fixtures or whatever it is that we're doing in our retail store. So two different kinds of opportunities, and then within those opportunities, there's obviously lots of choices. What we need in order to make a rational decision is we need to know what the investment is going to cost, and the cost may all come up front or it may come over time. So the expected annual cash outflows, and then the expected annual cash inflows over time as well. So what does that mean? Well, I'm going to buy a truck for $100,000 and I expect that truck to earn $20,000 net after all expenses in year one. And in year two, I expect it to earn $25,000 and so forth. So my outflows are the $100,000 purchase. My net cash inflows are going to be, expected annual inflows are going to be my net cash earnings from that truck. So obviously these are projections. We've talked about this a lot. They're not always accurate. They can be wrong. And the fact that they can be wrong leads to risk. If I was absolutely sure what my returns were going to be over time on a particular investment, I would have zero risk. But that's not really ever true. There's always some element of risk. I expect that this truck will earn $20,000 in the first year. That's my estimate. How confident am I in that estimate? Am I 100% confident? Am I 95% confident? Am I 90% confident? So we can adjust that estimate for our confidence level, or the assurance that we're going to be correct. So we know that we're not 100% sure, but we might be pretty sure. We might already have contracts written and expectations for this truck, that we're going to earn money with this truck. So we might be able to say we're 95% sure. Okay. So we're going to have to adjust what we expect at $20,000 by a risk factor. We have a 5% risk factor that we might be wrong, and a 95% risk factor that we might be right, and so forth. So we need to analyze any expected return versus the risk that it may not come in. And finally, we also have to look at the tax effect. And the tax effect is very real. If I put in after-tax dollars, I'm investing money that I've already paid taxes on in an investment. And that investment will get paid back over time, but as it gets paid back, I'm going to have to pay taxes on the earnings of that investment. Then I have to really look at how much tax I'm going to pay and look at the net amount I'm going to receive. So, because that's really what I'm putting in after-tax dollars and getting back pre-tax dollars, and really what I have to pay taxes on those things. So really what I need to look at is my after-tax return. So you have to look at the tax effect out to the future, and obviously once again that has some risk involved. Right now there's all sorts of news about potentially changing the tax code. Well, if you change the tax code on an investment you've already made, then you're going to have a different result, basically. So that's kind of where these information comes from. There are those three methods we talked about, and the payback method is certainly the one that non-financial people really understand quite well. How long does it take me to recover my initial investment? And the faster I get my investment back, the better the investment is. So if I get my investment back in 2 years, that's better than getting my investment back in 5 years. And to a certain extent, that's true. The faster I get my investment back, the lower the risk. I get my money back quickly, then the risk time factor is lower. Obviously, when I predict something 4 or 5 years out, there's a greater chance that I'll be wrong than if I'm predicting something 1 year out. So the risk factor generally goes up the longer it takes to recover my investment or to earn a return. So the payback method actually takes that risk factor into account and grades faster paybacks as better. But what it ignores is something called time value of money. And we'll talk about that before we go to our next things. But money that I get today is definitely worth more than money that I'm going to get 3 years from now? If I offered you $10,000 today or $10,000 3 years from now, which would you choose? I don't think there's probably any of you that would say, well, I'll wait 3 years for your $10,000. You'd say, no, I want it now. I can do stuff with it now. I can pay my tuition. I can put a down payment on a house. I can buy a new toy of some sort, a new tractor or a new ATV or a new kitchen, whatever. So there's no benefit to waiting for a return unless the return is greater in the future. So payback doesn't look at that. They're just looking at straight dollars. So here's a chart showing a basic payback model. We have an investment. We have 4 different possible investments, project 1 through 4. And each one of them is going to cost $500 or $500,000, whatever you want to call it. I'm going to call it $500. And they all have different returns. Project 1 and 2 both return $1,000. Project 1 returns it evenly, $250 a year for 4 years. Project 2 returns nothing in year 1 and 2, but $300 and $700 in year 3 and 4. Project 3 returns $500 in year 1 and then $50 in year 2, and that's it. And Project 4 returns $250 year 1, $150, $350, and $600, a total of $1,350. So my net return on these 4 projects, I'm going to return $500 on project 1 net, same thing on project 2, $50 on project 3, and $850 on project 4 over the 4-year period. How do I decide which project to take? Well, if I'm using the payback method, I'm going to get my money back in 2 years in project 1. It's going to take more than 3 years in project 2. I'm going to get all my money back in 1 year in project 3, and it's going to take 2.5 years to get my money back in project 4. Well, project 3 looks pretty darn good. I'm going to get my money back in a year, and the payback method would say the faster the payback, the better the project. Okay, so I'm going to do project 3. Decision done. Do you agree with that decision? Do you think that that decision makes sense? Payback is telling you to do project 3 because you get your money back fastest. But maybe that's not the best choice. I'm not sure. What do you think? Well, let's think about what the weaknesses of the payback method are. It ignores what happens after the payback period is complete. I got my payback in 1 year on project 3. Doesn't matter how much I get after that, I've got my money back. And it doesn't take into account any account of when the timing when the money is paid or received. It doesn't take into account the time value of money. So there are some weaknesses there. The strengths are it's very easy to understand. I got my money back. And it's easy to calculate because we don't have to do any math. We just have to add up, other than adding. We don't have to do anything other than add up our returns, and as soon as we get our money back, we know what the payback period is. So strengths and weaknesses, strengths easy to use, and definitely takes into account the risk factor, because if I get my money back, I don't have a risk anymore, right? I've already gotten my money back. I've known companies that have used payback and have been quite successful. I once audited a construction company that bought equipment, heavy equipment, for a project as long as they got a payback during the project. So they would buy a front loader or a crane or something because they could recover the entire investment in the 1-year project they were going to do. They had a lot of equipment sitting in their equipment yard that they used for one project. And the project was sitting there. It was paid for. They were happy. We didn't, it's paid for. No, we got all our money for that. We own it. It's ours. But it didn't have any utility for them after that. And was that a good project which generated enough money to pay for this big piece of equipment that we never used again? I would argue no, but they were successful. They made a lot of money. They were a successful construction firm, and that's the way they looked at it. That was their method. So payback can be used, and it is used a lot. And it's certainly easy to understand. I got my money back, I'm good. What it doesn't take into account is the time value of money. Time value of money means that money received at different points in time is not equally valuable. The sooner I get the money, the more valuable it is. I get the money and I can use it. So money received early is more valuable than money received late. Now, payback kind of takes this into account. The faster I get my money back, that money is more valuable than money I get back soon. So therefore, it is taking into account a little bit the time value of money, but it's not doing it in a very precise way or a very accurate way. Second method that we're going to talk about is the net present value method. It determines if a project will earn more or less than a stated desire of return. So the calculation, present value of $1 equals $1 divided by 1 plus an expected interest rate, desired rate of return, times with a factor of the number of years. So if it was a 3-year project, we'd be looking at 1 plus 5%, let's say that was our targeted return, cubed, if it was a 3-year project. So that's the formula. It requires a little bit more math than the payback method. That's still not terribly difficult math, but you have to have a calculator that can do square roots and cube roots and so forth. But not that hard. So net present value discounts future dollars. That's what we're doing here. We're discounting future dollars. So in order to use net present value, we have to do a few more things. We have to figure out what we need as a rate of return on our project. We call that the hurdle rate. So the required rate of return is the hurdle rate, and we need that to do this formula. We need to know what the interest rate is here. We need to have that I. What's the interest rate that we need, the rate of return that we need to make the project desirable? So we have to come up with a hurdle rate to compute net present value. And the project is attractive if it exceeds my hurdle rate. So if I have a higher return than my hurdle rate, then I'm going to exceed the required rate of return, and it's an attractive project. So I can rank projects and take the most attractive one, the one that exceeds the rate of return, the required rate of return, by the most. So how do I figure out the hurdle rate? Well, you need to know what I need to earn for investing money in a project. And we talked earlier a little bit about weighted average cost of capital. That's one way to look at what I need to earn. If my capital costs 8%, then I need to earn more than 8% in order to invest in a project. So we might use a hurdle rate that is based on weighted average cost of capital. Or we might use a hurdle rate that is based on my marginal cost of capital. So what does it cost me to attain the last dollars that I use in an investment? So might be the interest rate on the specific loan necessary to do this particular project. I need to borrow another $10 million to do this project. What will it cost me to borrow an additional $10 million to do this project? So that would be a marginal cost of capital used as a hurdle rate. And then the other thing you have to calculate in is that risk. We talked about risk earlier. What's the chance that I may not actually achieve my expected revenues and therefore not get my rate of return? So I have to put a risk factor in there. So I'm going to take however I determine my cost of capital and add risk to it to get my hurdle rate. So weighted average cost of capital is a starting point. Different industries have different needs for base rate of return, and we've talked about the marginal cost of capital. I jumped ahead there a little bit. As far as risk goes, I may have done similar projects to this in the past, and I may have a sense of what my risk is. I may be able to consult expert opinion as to what the risk factor is. So people who have knowledge of whatever the investment I'm doing or my industry may be able to tell me what the risk is. I open a new retail store in a new market. And I project my sales. What's the risk that my sales projections are wrong? That I don't generate the kind of revenue that I expect? When you see retailers closing all around you right now, Toys R Us going bankrupt, and Macy's closing stores, and JCPenney closing stores, and lots of bricks and mortar retailers are closing stores. Well, they certainly didn't open those stores intending to close them, but the market has changed. Risk has raised its head, and their estimates for revenues were wrong, and therefore the stores were not a good investment. They didn't achieve what they expected with them, so they are now closing, sometimes under the threat of bankruptcy. So figuring out risk is important. You can also use your own experience in the industry or others' experience in the industry to determine risk. The way you calculate net present value, you're comparing the present value of the project's cash inflows to the present value of the project's cash outflows. So presumably the inflows come from the future, the outflows happen at the beginning in most projects. So we want our inflows, the present value of our inflows, to be greater than the present value of our outflows. So we're discounting future returns back to present day dollars using the hurdle rate. So we're discounting them at 6% or 7% or 10% or 15%. Whatever our hurdle rate is, we're using that hurdle rate to take future dollars and discount them back to today's value. Obviously, if I can take $1 today and my cost of capital is 6%, that dollar will be worth more tomorrow or next year. It'll be worth 6% more next year if I can earn 6%. So by the same token, $1 that I receive at the end of next year is only worth 94% or 6% less today. So by discounting the cash flows back to today's dollars, we're able to compare today's investment with future cash flows denominated in today's value. So let's look back again at that same chart, the same investments, the $500 investments with the different returns. And we're going to assume a hurdle rate of 6%. So the value of these for this $1,000 discounted back to today's dollars, to year one 1/110's dollars, is $866.28. So my return is going to exceed 6% by $366.28. That means this project 1 meets my criteria for a good investment. Project 2, we compute net present value. We come up to $306.35. Less, because the money's coming in later, and these later dollars are worth less than these current dollars, or closer to current dollars. So even though we got $1,000 total, this $1,000 doesn't equal that $1,000 because these dollars came in later. Project 3, we got $500 year 1, so that's not discounted very much. And then we got $50 year 2, discounted a little more. But total net present value of all the returns over 4 years is $516. And then project 4, we got $1,350, but some of it came in pretty late, $600 in the 4th year. So my net present value discounted cash flow there is $1138.47. So I had a $1,000 investment, $866 of returns above 6%. Excuse me, a $500 investment, $866 above net present value of returns discounted at 6%, gives me a return above 6% of 366, 306, 1620, and 638.47. So the NPV method says you don't want to do project 3. That's the lowest value investment, even though Payback said that was the one to do. You want to do project 4 because it has the highest return over the entire life of the project in today's dollars. So in dollars that are the same as the $500 we're investing. So the actual return will be $638 better than a 6% return. So the pros and cons, it looks at the whole project life. It considers the time value of money and adjusts for the time value of money. The cons, it's more difficult to do than Payback. I could do Payback just in my head almost. Here I have to do some calculations, or I'll show you how to do this in Excel shortly. And the other con is you've got to figure out what your hurdle rate is before you determine whether you want to do the project, before you can even start analyzing the project using NPV. So what's my hurdle rate? Then I can calculate it. If I don't have a hurdle rate, I can't calculate it. So I have to figure out what my cost of capital is, or what marginal cost or weighted average cost, whatever I'm going to use. And I have to figure out my risk. So better answers, a little bit harder to do. And I've just spent 25 or 30 minutes explaining it. It's obviously harder to explain to non-financial people. The third method is called internal rate of return, and it really uses very similar math to what you're using in the net present value method, but it doesn't use a hurdle rate. Instead, it comes out with an internal rate of return. So it tells you your percentage return over the life of the asset, discounted to today's dollars. So it's discounting the dollars, but rather than starting with a hurdle rate, it just tells you the actual return. And let's look again at the IRR. And the IRR is showing the same investments. And we're showing the rate of return for each investment. So all of them showed positively under NPV because they all returned more than 6%. But now we can look at them and say exactly what they're returning. Project 1 is going to return 35%, Project 2, 21%, Project 3, 9%, Project 4, 44% annual return over 4 years. So that's pretty good. That's a pretty nice return. So that once again, this is going to give us the same answer as NPV, but in different terms. And it's definitely easier for non-financial people to understand this than looking at net present value, where we've got to know this hurdle rate. So companies tend these days to use IRR as their investment number, and then they really do the same thing as we did with the hurdle rate. They say we have a minimum IRR. We have to earn X% on any new investment or we won't do it. So we need to earn 10%, 6%, 18%, whatever. That's our minimum rate of return on new investments, and that's what we have to earn. So I'm going to stop there, ask you a couple of questions, and then I'm going to go on and explain how you do these calculations for IRR and NPV using Excel. And it's incredibly easy to do, and certainly something you should know how to do. So you need to know the concepts of NPV and IRR, and then I'm going to show you how to do them quite easily, and then I think you may well have a small project to do on NPV and IRR. So that's the completion of this piece of the project. That's this piece of the PowerPoint, and we'll go on to the next one after you've answered your questions. Thanks.